Hi, good afternoon. Good morning to those of you on the West Coast. Welcome to the Sidonian Company June Virtual Investor Conference. The next company up is Quipt Home Medical. With us, we have the CEO, Greg Crawford. As always, this will be a 30-minute presentation. If you have any questions, you can type them into the Q&A screen at the bottom of you, at the Q&A box at the bottom of your screen, and we'll get to those at the end. And with that out of the way, it's all yours, Greg.
Thank you. And thanks everybody in that for listening to our presentation today. So just a little bit of highlights on Quipt and that where we are financially and operationally, and that as we stand as of our last quarter close in that, which would have been March 31st. We stand at about $245 million in net worth of revenue, about $57.9 million worth of adjusted EBITDA. We've completed annually over 850,000 deliveries. We've got over 300 active patient lives under our care. We've got over 36,000 referring physicians, and we're currently in 26 states with over 130 locations and over 1,200 team members. We think from a revenue perspective, as it relates to durable medical equipment and home respiratory, that we're the fifth largest provider in the U.S. We are currently dual listed on both the NASDAQ and the TSX. Our Q2 in that 2025 and that highlights is that we produced $18.2 million worth of cash flow from operations. Very strong recurring revenue model that's been very, very consistent for us in that over the years, sitting at 81%. Balance sheet, and that is net debt to EBITDA leverage, and that is 1.5 times. We've just got over $47 million worth of liquidity, and the inside owners between board and management, and that we own just about 10% of the outstanding shares. Just to talk a little bit in that here, just about our history in that for those of you that are not familiar with us, in that just to kind of go over a little bit with that. We were listed in Canada in that some time ago, back in about 2012. The company became dual listed on the NASDAQ in May of 21. We were in about 7 or 8 states in that during that time frame. In August of 21, in that we surpassed and got the 15 states covered in our fiscal year. We surpassed $100 million in revenue. By December of 23, in that we had 26 states covered with those 130 plus locations in that. So as far as our path forward in that, we continue to monitor the market in that for acquisitions, and that would be accretive in that to our long-term growth and creating shareholder value. And we've also been laser focused in that on regaining our organic growth in that initiatives in that throughout the organization. Part of our acquisition plan, and that would be to capitalize on opportunities like we've historically done with cross-selling and expanding into other products in that across those acquired companies in that. As of right now in that, things that we've been looking at is to solidify relationships in that with health systems in that to where we would be able to partner with health systems and one, either potentially acquire their current DME company and be able to take over that operations, or potentially create joint ventures in that. We're kind of looking at all methods in that we would be able to partner with in that to get deeper inside those health systems. Once again, that strong and recurring revenue model, and that it is sitting, these numbers here are kind of updated on a fiscal year annual basis, and that so the recurring revenue is showing slightly lower here at 78%, but it typically in that has been right around that high 70s in that low 80s range. 22% is sales. Our service mix in that over the years has relatively remained the same, in that pretty diversified, with being about 80% respiratory, and the rest kind of being home medical equipment, and then our mobility coming in at just about 20%, or sometimes just over 20%. Our payer mix in that continues to remain pretty diversified there, with private insurance accounting for about 40%. Traditional Medicare is around 25%. Our Medicare Advantage plans through the private insurance companies is around 10%. Our state Medicaid programs is 7%, and our private and patient pay, and that is about 18%. Once again, just to kind of highlight in that kind of our coast to coast coverage in that there with our 26 states and our 130 locations, and that we've really solidified a big presence in the Midwest and the Southeast, primarily targeting states that have a high prevalence of COPD and other respiratory conditions. Just some of the industry tailwinds to support organic growth. And that the industry is kind of seeing here is that there's 10,000 Americans turning 65 or older every day. It's estimated there's over 16 million COPD sufferers in the U.S. alone. And then, of course, the untapped sleep market, it's estimated there's $80 million U.S. population that's affected in that by sleep apnea. Also, the number of Americans suffering from 3 or more chronic diseases, and that is over 30%. There's been a lot of information out there about GLP-1s, the usage of GLP-1s to date. In that, we really haven't seen any negative effects in that on our business as it relates to the utilization of GLP-1s. In fact, in that there's been a study that's done in that by the largest sleep manufacturer out there that's actually showed a much stronger demand in that for patients wanting to utilize their CPAP and also utilizing more CPAP supplies in that when they are on a GLP-1 medication. As far as our marketed position in the market, in that there our diversified product mix, and that has relatively kind of remained the same. Our core focus products in that have been home respiratory, including home ventilation, home oxygen therapy, and sleep therapy, and then of course the complementary equipment solutions in that to continue to help those patients stay in their home. We have a very patient-centric ecosystem in that with the monitoring in that of our ventilators, our sleep products, and other respiratory devices to where we're remote monitoring patients in order to ensure that they're adhering to their therapy. Everything that we do in that primarily is in-home delivery and setup. We do a little bit of a virtual setup, and then mostly a fair amount of in-office setup, and that for our sleep products. But otherwise, in that most of what we do in that is direct to the home. As far as some of our growth levers in that here and that we're able to pull in that here to continue to allow the company to grow, it's just the organic growth. We have historically up until the past year or so, in that we had grown in that 8 to 10% organically. We have had some challenges in that with organic growth, with some changes in reimbursement and some other dynamics going on in the industry, and that has stalled our organic growth in that. But we've got plenty of levers in that we feel that we're pulling here, and we're going to have a get back to that historical organic growth. The other piece that's been a big part of our growth in that over the years has been our synergistic acquisitions in that, which we have a pipeline in that we're looking for. Like we've mentioned in that, we've primarily been focused on healthcare systems in that we've been able to potentially partner with, and looking at those types of acquisitions going forward. We've been able to manage our debt in that and stay right there at that 1.5 or so, and that kind of net debt in that to EBITDA in that over the past couple years or so. And then we continue in that to work on our operating leverage and being able to create economies of scales, as this is truly an industry of scale. And the team has done an excellent job of being able to maintain our adjusted EBITDA margins in that, even despite some of the stagnant and lack thereof growth that we've seen in the business due to some of the challenges that we've had. Just kind of another slide here, kind of moving on to driving some of those economies of scales in that we've been able to see that we've still been able to kind of grow that adjusted EBITDA margin, even despite inflation that we've seen a few years ago, and even despite some of the decline in revenue and some of the decline in reimbursement in that we've seen within the business over the past couple years. Technology utilization, and that has been a big part of that for us to be able to implement technology in order to reduce some of the friction points in that and create organizational efficiency in that throughout the company, and that whether it be RCM with our revenue cycle, our order fulfillment, project management, and finance and accounting reporting in that in order to get timely and accurate data in that to our operators, and that so they're able to make real-time decisions in that within their business units. On to kind of our financial profile here, and that just looking at our financials for our fiscal Q2 25, which ended 3/31. We came in with revenue at $57.4 million and adjusted EBITDA at 13.4. The adjusted EBITDA margin in that was 23.3%. And once again, that strong recurring revenue model, and that tends to hold very steady for us, and that as we continue to move throughout the year. Financial full year for fiscal 24, and that ending September 30th, 24, we've seen that $245.9 million worth of revenue, and then $57.9 million at worth of adjusted EBITDA, even despite some of the reimbursement challenges and insurance challenges that we had seen in that throughout our fiscal 24. Just kind of looking at our cap structure and inside ownership, in that at the date of this deck, in that our market cap was about $76 million, our enterprise value at about $161 million. We had about just over 43 million of our basic shares outstanding. We had about $30 million in that in our senior credit facilities available, and then just over $17 million in cash. So I can kind of stop there. That's the end of the presentation. I can open up for any questions.
Great, thank you. So, you indicated that the revenue growth slowed in the first half of the year. What can you do to reignite the organic growth in the back half of this year?
Yeah, so there's been, thank you for that. So there's been a lot of levers in that we've been pulling in that really over the past few quarters, in that, and some of those have been the expanding of our sales force. We've created a sales academy in that to get all of our sales rep through there to ensure that they're able to cross-sell and that all products in that they have in the tool belt to sell. This year, we've opened up some de novo locations. We continue to work with our referral networks in that in order to be able to cross-sell different products and kind of rebuild with some of those different working relationships in that we've had. So we, as we had kind of mentioned in that in our last quarter, in that we exited in that the quarter in that pretty strong there in March, in that as it related to kind of our resupply business and things. So we're starting to see things head in the right direction, in that for us to be able to get back to that historical organic growth that we've seen.
Right, and the recurring revenue, has been very consistent, up over 80%. Is this something you think continues, and is this built into your outlook over the next couple of quarters?
Yeah, absolutely. In that, we think that's going to continue to hold steady in that, just because we, continue to see strong demand inside our resupply business, which is recurring in that for those patients, and that getting those sleep resupplies for us, and then our rental business in that continues to stay steady, and also has shown some signs in that of growth in that there within our rental business. So we feel pretty confident that that's going to remain strong.
All right. One of the things that I stood out to me is that despite the top line pressure in the first quarter, you were able to maintain your EBITDA margins above 23%. How are you able to do that?
Yeah, we've really been able to just kind of optimize in that the business and our operations, and that continuously working on operating efficiencies, centralizing some of our intake processes, and really just looking at overall cost and efficiencies throughout the organization. And we're able to do that in that because, we've really been able to kind of scale the business in that over the years, in that, and as we've been able to centralize things, I think that's probably been the biggest help for us. And then, of course, the implementation different technology platforms.
All right. One of the other things you've talked about in the past few calls is your strategic partnerships with the healthcare systems. How are you progressing, signing new ones, and how does that factor into your growth strategy?
Yeah, we expect that that's going to be a part of our overall growth strategy in the second half of the year. Very, very positive on that front, and about really kind of embedding Quipt in that inside these healthcare systems, in that it allows us to work with hospital discharge in that planners directly, rather than kind of waiting for them to call us or anything. So some of the ones, we've got active discussions in that with ones that are more regional type healthcare systems. So we continue to expect to kind of grow that pipeline, and we think overall that'll help accelerate in that our overall organic growth, in that as we look to partner with them.
All right. Yeah, several months ago when all the news about the GLP-1s came out, a lot of stocks pulled back because they thought treatments wouldn't be as necessary. One of those treatments would be sleep therapy. Are you seeing any long-term effects from the introduction of GLP-1s?
No, we're really not. And I think really kind of some of the recent studies in that you've seen from the largest sleep manufacturer, in for example, in that the GLP-1 users in that with OSA are like over 10% more likely to initiate sleep therapy. And then they've also shown some higher resupply rates, and that where they're ordering supplies more frequently. So we think that just kind of underscores in that the importance in that of people just wanting to take care of their overall health, and sleep is a part of that. So we've kind of seen that business continue to hold very steady for us.
So it sounds like the GLP-1s are more of a tailwind than a headwind for you. Is that right?
Yeah, yeah. I mean, they potentially could in that. I mean, we haven't seen that exactly in our business yet, to where it's brought in a whole bunch of new patients, but we certainly know in that it's been able to hold steady in that for us. And more and more people in that are concerned about living a healthier, happier life, and sleep is a part of that. So they're going to still have to continue to treat sleep issues.
Okay. All right. And I cover a company, Infuse Systems, and they provide capital or infusion pumps. And with their business, when they are investing in CapEx, that's usually leads to higher demand over the next couple of quarters. Um, you can you provide color on the CapEx spending that you've had, and how should we interpret that relative to your historical norms?
Yeah, so we have seen over the past few quarters in that a slight increase in our CapEx spend as a percentage of revenue. The majority of what we're seeing in that is due to the Philips vent recall. So we're kind of refreshing our fleet. So we think overall in that this is ultimately in that going to lead to us, instead of having to do something gradually in that, we're really kind of jumping right into it, because there's some trade-ins and things like that that we're able to do as we get these vents back. So this is really going to lead to a much more updated fleet. We also do expect in that there'll probably be some credits in that will come later in the year, which will kind of be a net positive in that for us. So we think that by the time we go back and kind of look at this over a 12-month period, or kind of throughout our fiscal year, that we'll get back to our historical levels of that 12 to 13%, versus I think we've seen just over 15% or so over the past few quarters or so.
All right. One of the reoccurring stories is tariffs. They were in the news again this week. Are the tariffs, do they pose any risk to your costs or your product flow?
Yeah, so nothing that's widespread. And I think one way to kind of explain it is we don't have a lot of price control in that over what Medicare pays us, or insurance companies outside of negotiating a rate. So we can't just go raise the price in that once we see a tariff or something. So those products in that are relatively in that all exempt under the Nairobi clause. So we've seen very, very little tariff charges that we're not able to pass along because we do have items that we sell as retail cash or something, but those things we're able to control and pass those costs along. So to kind of sum that up, we don't expect there to be any negative impact in that whatsoever in that from tariffs at this point in time.
Can you talk about your capital allocation philosophy? I know you said that the leverage ratio is around 1.5 times. Is that where you want to keep it? And if you're willing to spend, would it more likely to be on acquisitions, share repurchases? What's the strategy going forward?
Yeah, yeah. As far as our strategy going forward, I mean, we would certainly be in that comfortable in that going higher in that on our leverage ratio there, but I doubt we probably would go over 2.5 times in that. But we're open in that to looking at all ways to allocate capital. Right now, we've been laser focused in that on investing in the business for organic growth, and then continue to pursue in that these healthcare system opportunities in that, and utilizing primarily our capital for those because we believe that's going to build the most long-term value for us as we continue to build scale.
And in the past, when you have added products, are you able to use the same revenue cycle management team? Are you able to leverage some of that infrastructure?
Yes, absolutely. Yep, that's been a big part of how we've been able to kind of maintain that adjusted EBITDA margin anyway, and that has continued to remain strong for us. And that is because we've um, uh, been able to make those departments and that as efficient as possible, and that as we continue to centralize and that the business and look for ways to improve the efficiencies.
And is that one of the reasons why your partners choose to work with you because you take that task away from them and you handle it for them?
I think most of our partners in that really choose us for our service level. A lot of the things in that we kind of talk about happens in the background, and it's that overall creating that patient experience and that and being able to deliver in that great service and care and really compliance in that to these high acuity respiratory patients, which is what a lot of these physicians and healthcare systems are looking for out of a home health provider.
And when you look at opportunities, I mean, do you want to stay in the respiratory markets or would you go into other health, other treatment markets?
Yeah, I think primarily in that. I mean, we are a respiratory provider in that. That's what we're kind of laser focused on, but we're always looking for additional opportunities to add additional products and things. But at the same time, in that we don't want to forget about our core business and our core strength and that's being laser focused on treating high acuity respiratory patients in their home.
And how about geographic expansion? I'm still on the map. There's still several states where you are not you're not participating in. I mean, do you plan to expand geographically over the next few years?
Yes, absolutely. And that we would love to start filling in that some of the upper Midwest and some things up into the Northeast. So those are kind of some states that we have on our radar that are kind of at the top of the list for us, and that show a high acuity of respiratory patients that kind of fit right in that to what we're doing. So those are just one of the levers that we're kind of looking at here in that to get the business back to its organic growth levels. The one thing that we can say is that our business, even despite the challenges that we have, is the underlying business and that is very structurally sound. And we've really been working in that diligently and that to turn over every stone that we can to try to create shareholder value and take advantage of some of the overall macro tailwinds in that we're seeing in the business.
And up till now, I think the growth has all been funded, with cash from operations. I mean, is that the plan going forward as well?
I mean, as of right now, and that I mean, we would continue to fund any growth in that we have, and that would be through our either our credit line or through our general cash flow from operations.
Okay. All right. And then last one is, so you look ahead towards fiscal 2026, what do you think your biggest opportunity is and what gives you the most confidence right now that you'll be able to, restart that growth?
Yeah, so those are all the levers, some of the things that we've kind of talked about on the phone here today, and that whether it be expanding our sales force and that ensuring that all of our sales reps and that are trained properly, able to cross sell in all markets, de novo expansion, continue to work with payers and that to be able to broaden in that our contracts with them across the U.S. And then at the same time, ensuring that we're operational efficient and that at the same time be able to create in that as much in that income as we possibly can in that throughout the organization.
All right. We are just about out of time. Do you have any closing comments before we end this today?
Yeah, just appreciate everybody taking the time today in that to listen. We are diligently working in that once again in that of pulling all the levers we can to get back to the historical organic growth that we've seen, our underlying business, and that once again and that we believe is very sound, and we expect to be back to organic growth in that hopefully sooner rather than later.
Okay. Well, thank you. Thank you for your time to do the presentation and your time today with the meetings. And we hope to hear from you again soon and get an update on how you're doing.